Business combinations, consolidations, all the works. Let's look at some questions. How should the acquirer recognize a bargain purchase in a business acquisition? So you've got two possible situations when you buy a business. One is you pay more than the fair value of the company, and that should sound familiar. If it does, you'll know that if you pay more for a company than it's worth, you create goodwill. One note on goodwill: it cannot be internally created. Goodwill is an intangible asset. Like, what's the whole point of paying more for a company than it's worth? There's a bunch of reasons, but really it's to show, like, what is goodwill? It's faith. Like, you're showing good faith. So that happens when you pay more than the fair value of the company. So we are not going to recognize goodwill in this one. That would be if we paid more, and that's not a bargain, right? If you pay more than the company's worth, it's not a bargain. Also, similarly, there's no such thing as goodwill, negative goodwill. There's no such thing. It does not exist. Trick answer there. Because you'd think, right, if you have goodwill when you pay for more, and if you have a bargain purchase, you're paying less, there's no such thing as goodwill. It's trying to trick you. Next, we have as a deferred gain that is amortized into earnings over the blah, 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 blah. Not anything near the truth there. We're not going to want that one. So as a gain in earnings at the acquisition date, it's basically as similar, like if you were to buy a building and sell it, if you recognize a gain there because of you paid less than you should have, it's going to be a taxable event. So similarly here, you're going to have a gain in your earnings and your net income in your income statement at the acquisition date. Those are just the two different treatments of what you would do. And maybe you pay exactly the fair value, which will never happen. You will never get a question on that. So if you know the answer to what would happen, if you want bonus points, let me know. All right. Moving on. Next question. Tulip Company owns 100% of Daisy Company's outstanding common stock. Tulip's cost of goods sold for the year totals $600,000, and Daisy's cost of goods sold is $400,000. During the year, Tulip sold inventory costing $60,000 to Daisy for $100,000. By the end of the year, all transferred inventory was sold to third parties. What amount should be reported as cost of goods sold in the consolidated statement of income? All right, we got a little intercompany here, a little consolidation. Let's take a look. Well, we've got dividends, we've got cost of goods sold, we've got sales, we've got revenue, we've got expenses, and there are different treatments for each of these when it comes to consolidations. Like, what do we eliminate? What do we partially eliminate? What do we just combine? So in this case, the total amount of cost of goods sold should be equal to the cost to parties outside of the consolidated entity. Because what does that mean? That's essentially saying you are eliminating the intercompany. In this case, you want the amount of cost of goods sold of the goods that were sold to external, non-affiliated, non-owned 100% by Tulip entities. All right, so Tulip reported 600 and Daisy reported 400. I'm going to make some notes here, do a little math, show you how we do it. So we've got 400, and this is how the consolidation process would work. Then we've got 600. All right, so right off the bat, you think, all right, that looks like $1 million. However, it's not going to be that straightforward. We are going to eliminate some of that because Tulip sold inventory costing 60 to Daisy for 100. So we want to eliminate this amount. So we know the answer is not going to be 1 million. And we've got 3 other possible choices. Now, do we use 60 or do we use 100? I'll give you a second to think about it. So in this case, we are going to use the 100,000. We're not going to use the 60,000. Because we sold it to Daisy for $100,000, and to Daisy the cost of goods sold was 100. We're using it from Daisy's perspective. That's Daisy's cost of goods sold because that is the subsidiary, and that's what we want to eliminate out of there. So we're not going to use that. That eliminates letter B. Letter C, I don't know how they got that one, so we're going to eliminate that one. And final answer here, because it just doesn't make sense to include the $100,000 of intercompany, because that's double counting. So final answer here is going to be $900,000. Awesome. Great question there. Hope you all enjoyed, and see you next time.